Welcome to our conversation on financial statements. In this session, we will see the financials of Shadowfax Technologies, which was in news in the recent past because of its IPO. Shadowfax Technologies, they deliver goods. It's a technology-led third-party logistics company. It operates an asset-light last-mile delivery network. It serves e-commerce, quick commerce, hyperlocal delivery clients. It covers about 14,758 approximately PIN codes nationwide through partner networks. That reach has given them an edge to capture about 23% of the market share in the third-party logistics in the year 2025. The market to which this particular company belongs to is growing very fast. The online retail market is the fastest growing channel in India, with an estimated growth of 20 to 25% growth rate between 25 to 2030. Moreover, the quick commerce business is growing even faster at 50 to 62% till 2030. The Shadowfax Technologies is one such company that ensures online orders move from the warehouse all the way to our doorsteps. Because the market is growing, so that the expectation is the Shadowfax Technologies will also do well. Who are its clients? Its clients like Zomato, Meesho, Myntra, Swiggy, Zepto, um, Big Basket, and so on and so forth. It came to IPO to the market in the third week of Jan with a price band of 118 to 124, and the total size of the issue is 1,907 crores. Out of this 1,907 crore, fresh issue is only 1,000 crore and 907 crore is the offer for sale. The fresh issue, as expected, the money will go to the company, and offer for sale, the existing investors will sell the shares, and the existing investors are the early institutional investors like Flipkart, NewQuest. They will be offloading their stake through this IPO and make some returns and profits. What will they do with the fresh issue? As per the RHP, the funds from the fresh issue will be used for network infrastructure expansion, lease payments, for first and last mile sort centers, for branding and marketing, for potential acquisitions and general corporate expenses, and a significant portion of the proceeds will go to meet the company's working capital requirement. Because with the size of the business growing up, in future, the working capital requirements will increase. Now let us see the financials. Just like any other startup IPO, in this case also, we can see from the RHP, the loss has been converted to profit. In FY23, there was a loss. FY24, loss narrowed. FY25, it's shown a profit of 6 crore, first profitable year. And the half year of FY26, profit went up by more than 3 times, 21 crore. So we would like to understand what happened. How did this happen? So the revenue, as expected, this business to a large extent depends on the growth of revenue. The revenue of Shadowfax increased from 1,415 crore to 2,485 crore in 23 to 25. However, the margins are very low. The profit margins are less than 5%. This is operating profit margin. So in 2023, it was negative 8%. In 2024, it is 1%, and 25, it is 3%. So the operating profit margins have increased, but it is less than 5%. And can this company maintain this profit? So sustainability of profit is a very important managerial question. As we have seen, the margins, operating margin itself is less than 5%. The net margin is below 1%, a very thin buffer. So a small change in any of these expenses may wipe out this profit. Any rise in fuel cost, labor, or incentive costs can impact this profitability. So profit sustainability of a company like Shadowfax will depend on volume growth, pricing, and continued cost management or cost discipline. In that direction, in the endeavor of managing cost, there's a need to understand the nature of the fixed cost and the variable cost. The company runs an in-house logistics management system. It handles routing, real-time tracking, this automated payments, dispute resolutions across millions of deliveries. This is the backbone of the company. The company also runs an in-house system for partner management, fraud detection, and address intelligence. The cost of building and maintaining such systems barely changes whether a company handles 10,000 deliveries or 10 million. So these are sunk costs or fixed costs. Small players often struggle in this area, but established players like Shadowfax are expected to survive by spreading the fixed costs across volume. So for a company like Shadowfax, the volumes are going to play a very important role. Volume is going to affect the cost per unit as well as therefore the profit. In the same way, the variable cost, to a large extent, the employee cost in this. So, unlike many other companies, Shadowfox depends on a crowdsourced delivery workforce with over 2 lakh active delivery partners, incentives, seasonal demand. The regulatory changes directly affect this availability and cost. So, any tightening of gig workers rules or rider shortages would quickly affect the margins and service levels. So on one hand, the huge capex, the IT-driven expenses, and then there's no control of the workforce are going to affect this company's bottom line in a big way. If you see the profit, in 2023, 1,426 million was a loss. In 2024, the loss reduced to 118 million. In 2025, the negative 118 million loss becomes 64 million profit. And 2026, 6 months, the profit was 210 million. So obviously, there is a need to understand how did a huge loss become profit? Is it because of operations or is it because of any accounting adjustments? The reduction in the loss and creation of profit one can observe is because of, to some extent, because of the reduction in the exceptional and one-time expenses, lower ESOP related non-cash charges, better alignment of revenue recognition, so it's more an accounting definition of revenue, normalization of depreciation and amortizations, which are non-cash expenses. Even ESOP related expenses are non-cash. So the change in the profit from negative profit to positive profit to a large extent, in this case also, is because of certain accounting adjustments. The ESOP and non-cash expenses, earlier years, heavy ESOP costs booked due to aggressive hiring, high non-cash expenses, inflated losses. But in the recent year, ESOP charges declined significantly, lower dilution related accounting expenses because ESOP, as per the accounting standard, has need to be amortized. No cash flow, but there's an amortization of ESOP is shown in the income statement affecting the profit. So the net profit benefited increase without the corresponding impact on the cash flows. Now let us see the leverage. The company leverage is very low. So the impact of debt on the income statement is low because the debt equity ratio is only 0.2, 20%. However, there are non-interest bearing liabilities also there, and we'll see that. The lease liabilities, they reflect because this company is an asset light company, so the lease liabilities significant is reflect the asset light operational model. And the lease liabilities over a period of time have increased from 60 million to 1469 million. So this is a this is not part of calculation of conventional leverage. So the leverage is low without this recognizing the lease liabilities. Why this lease liability matters for investors? Logistics company with extensive leased infrastructure often have large lease liabilities. The lease liabilities affect cash flow planning, financial risk, even if they're not part of the conventional debt for the definition of debt equity ratio. The rapid increase signals aggressive networking scaling, which can boost growth but have fixed obligations in the form of lease payable. So there is a huge amount of recurring regular cash flows. Unlike a purchase of fixed asset where depreciation, fixed asset acquisition, huge cash outflow at one point of time. But lease payment, regular recurring cash flows. So this can be one of the risks. Another liability which is sitting on the balance sheet is a payables to customers. This is a typical of this type of companies like Shadowfax. Payables to customers against cash on delivery, and we'll understand them more. And this liability, normally shown as the current liability, increased from 53 crore to 148 crore. What is this liability? In cash on delivery model, Shadowfax collects cash from the end customers at the time of delivery on behalf of its clients, e-commerce sellers and platform. And this they have required to pay them back to the e-commerce sellers. Because Shadowfax is only a collection agent, the money collected must be remitted to the customer. Hence, it is recorded as a liability. So the increase in the liability from 53 crore to 148, this is not a loan, this is not lease, but the money collected by Shadowfax from the customer to be given to the e-commerce sellers and platforms. And this will sit on the balance sheet as a current liability. But there's a risk associated with that. One is a cash handling risk, especially in the last mile deliveries. fraud or pilferage, by delivery partners, possibility. Reconciliation delays, because you have so many places, so many centers, so many collection partners. So it will affect the reconciliation. As a result, it will affect the working capital. At the same time, and it brings that operational complexity as the volume increase and your partners increase. So cash on delivery, though it is not part of the conventional debt equity ratio, as an investor, we should keep a watch on this number because there is a risk element involved in this. Other risks, the other risk is the concentration of clients. We can see that one large customer accounts for 49% of the total revenue. Top five clients account for 74% of the total business, and top 10 account for 84% of the business. So, high concentration of revenue from a limited number of clients poses a significant risk to the financial business. The financial will have a financial impact if there is a change in any of these customers can leave this company. If the competitors provide better service, they will just move away. So there is a need for the company to keep a watch on it and diversify, increase the basket. Concentration of delivery partners, dependence on non-exclusive gig workforce comprising of 2 lakh average quarterly unique transacting delivery partners with whom the company is not having any exclusive agreement. So this is definitely a weak point. As well as, of course, is the strength. The strength is they have 2 lakh, more than 2 lakh delivery partners, but they don't have any exclusive agreement. They can move away at any point of time. Any change in the rules will affect them. And moreover, this business itself operates in a very thin margins, and there's this high competition like rivals like Delivery, Blue Dart, Express Bees. With this intense competition, pricing pressures, variable fuel and partner costs can actually compress the margins further. So it's the volumes are high, but the margins are low. Volumes high, margins low, high competition, maintaining, sustaining profit is not easy. Contingent liability. Often investors ignore this item. It's always important to observe this liability. You don't see that on the balance sheet. It is off balance sheet item. And every company shows that, has um, in the RHP, it mentions about the contingent liability. So in this case, in Shadowfax, the contingent liability is not high, but the company says that there is a contingent liability of 2.3 crore and there is no provisions have been made. So RSP cautions that if any of these contingent liabilities materialize, it could adversely affect the company's results of operations and financial conditions. That debt equity ratio of zero point 0.2 or 20% is not is without taking this contingent liabilities. Another interesting financial instrument sitting on the balance sheet is a compulsorily cumulative preference shares, popularly known as CCPS. CCPS, which typically mean they are mandatory convertible into equity shares before IPO. Many early investors prefer to enter a company, invest in early stage through CCPS, through they're assured of certain returns, and when the IPO happens, they become the equity holders. So, Shadowfax has also a huge amount of CCPS on their balance sheet. On and off over a period of time, they've issued several series of, at different stages of their operations, they've issued different CCPS, multiple CCPS series with a different conversion rates, conversion rate into equity share. You may ask, so what? What is the impact? The impact is the CCPS number may look small. For example, Series A is only 82,320 CCPS. But when they're converted, each CCPS is converted generally into hundreds or thousands of equity shares. And once fully converted, equity share base increases. And once the base increase, all other parameters based on the equity, number of shares, and capital, that is value of the equity, all will go for a toss. Because CCPs convert into equity before listing, the earning per share falls. Earning per share is packed by number of shares. A number of shares, if you convert, diluted EPS, don't see basic EPS, the diluted EPS will definitely fall. Price earning ratio may look cheaper or expensive depending on the conversion. Who are the holders of the CCPS? Generally, the venture capital, private equity, and early strategic investors are the holders of CCPS. Once they convert, they become normal equity shareholders and they are free to sell after the lock-in. Now, this is also another important point. Now, after the lock-in, the CCPS holders who become the equity shareholder will suddenly sell the shares in the market. The selling pressure may pull down the price. The potential selling pressure post lock-in is always there. So price may become very volatile. So the impact of the conversion of CCPS in equity and then the sale of equity by these owners, holders of C. So as a potential shareholder, look at the post-conversion equity share capital. Recalculate EPS, observe the diluted EPS. Observe the impact of converted CCPS on ROEs, market cap, and at the time of just before and after this post lock-in selling pressure, the price may become very volatile. So there is a need for the investors to keep a watch on CCPS. Observe what percentage of CCPS will be converted and what will be the impact of the conversion on most of these financial parameters. To summarize, so Shadowfax is a have high revenue but low margins, large customers but high customer concentration, large number of delivery partners, but a very limited control on the delivery partners. High current liabilities because the money collected from the customers to be given back to their platforms and e-commerce. High current liabilities, stiff competition, and usual the growth related operational risk. So it's a tough question to decide, whether to invest or not. Shadowfax has been delivering goods to the customers successfully, meticulously. Will it deliver value to the investor? Only time will say. Hope Shadowfax will live up to the legacy of its legendary inspiration. Thank you very much.